Welcome to the Savvy Ladies Wednesday Wisdom webinar. I'm Maggie Montemuro, and I'm the Marketing Manager at Savvy Ladies. If you have a question during the webinar, you can type it into the chat box. And if you're joining us by phone, you can email your question to info@savvyladies.org. Today's presenter is Lisa Horowitz, founder of Life Cycles. She has had her own insurance practice for 29 years. Lisa is a highly experienced broker and specializes in negotiating across many health industry platforms, such as life insurance, long-term care, Medicare, and all its iterations. Lisa's expertise also extends to management of long-term and end-of-life care, and she is an expert at navigating the worlds of public and private health-related benefits. Lisa is a chartered life underwriter and a chartered financial consultant. Thanks for joining us, Lisa, and I'll hand it over to you.
Very good, Maggie. Thank you so much. Good afternoon, everybody. I'm Lisa, and I want to first and foremost thank Maggie and everyone at Savvy Ladies for inviting me this afternoon to present this webinar on life insurance and annuities, a practical introduction. What I'm hoping to accomplish today is to give everyone an introduction, a little bit of education, and some tools and some questions that they can mull around in their mind to figure out what their own needs are, what their own ideas are about buying life insurance, buying annuities, what they're for, how they can be incorporated into your own individual personal financial planning. Please, again, as Maggie said, if you have any questions, please feel free to ask them in the format that she suggested. And if everyone's set, I'm going to get started. So there's that great picture of me, and at the bottom right of that little picture is the top of my 13-year-old's head. So just to give you an idea of who I am. Life insurance and annuities, a practical introduction. So let's talk about life insurance first. Life insurance is something that is purchased as what we like to refer to as the foundation or the building blocks of a successful financial plan for people. A lot of times people will say to me, I don't need life insurance, I'm not married, I have no children, and that most of the time can be true. It also cannot be true. What I say to people is if you have anybody who is dependent on you financially, if you have any assets that you want to protect and preserve should something happen to you, if there is a charitable organization that you're interested in giving a substantial gift to in the future, life insurance is for you. What life insurance really is it's the creating of an immediate pool of money, a large pool of money, for what can be very small dollars up front. So let's talk for a minute about the different types of life insurance policies that are out there in the market today. We have term insurance, we have whole life insurance, we have universal life insurance. The fourth one, which is the variable life and variable universal life, I'll get to in a minute. That's more of an investment, but for purposes of this conversation today, let's focus on term, whole life, and universal. What I like to tell people is that there are basically two different types of insurance. There's the kind of insurance that you buy when you have a specific period of time in mind that you need to protect either a family member or your family, or you're funding something for education, or you have a loan obligation like a mortgage, and that's when we use term insurance. Its term is usually short for temporary or term of time. When we look at term insurance in the marketplace today, we see everything from 10-year guaranteed renewable, 15-year, 20-year, and 30-year. And what that means is the premium is guaranteed for the first 10 years that you keep the policy in place, the first 15 years, the first 20 years, the first 30 years, at which time the policy, quote-unquote, expires. Usually, people have the opportunity to continue these policies when they're finished or when they expire. However, insurance, life insurance, all life insurance is based on how old you are at what we call attained age. In other words, how old are we when we're buying the insurance? The rule of thumb is the younger you are, the less expensive it is. So, and the other rule of thumb to remember with term insurance is the longer you're asking the insurance company to guarantee that level premium paying time, that 10 years, that 20 years, that 30 years, the longer the period of time you're asking for the guarantee, the more expensive the premium is. So we're looking at 10-year term, we're looking at 15-year term, we're looking at 20-year term. All of these policies, again, have a guaranteed premium for that set period of time. They have a level amount of protection, in other words, face amount, which is another term we use for death benefit. So, for example, somebody could buy $1 million of 10-year level term. They could buy 20 years of $1 million of level term. It means that whatever that premium is, it will stay in that mode until that policy expires. In year 21, in year 11, depending on which policy you've purchased, the premiums will increase based on your newly attained age. So if you bought a 10-year policy and in year 11 you want to keep it, you're 11 years older, the premiums go up. So there's a level premium, there's level coverage, and there is no cash value at all. When you look at the illustration or you look at a quote for term insurance, you're going to see two columns. You're going to see premium and you're going to see death benefit. As opposed to whole life or universal life, which I'll get more into in a minute, there are other columns that show some of the premium going towards what we call cash value or the savings portion of the insurance policy. But let's get back to the term insurance for a minute. So there's level term. There's also annual renewable term where it's not level for 10 years or 20 years. It could increase every year. But again, the coverage is the same and there is no cash value. Let's talk about whole life for a minute. Whole life is at the other end of the spectrum of buying life insurance. It's the most expensive form of life insurance. The reason being it offers the most guarantees. You have a level premium for the life of the contract. So if you buy it at age 25 or you buy it at age 40 or you buy it at age 50, whatever rate you're given at that time is the rate you're going to pay throughout the life of the contract as long as you keep it. The coverage is absolutely level. If you bought $500,000 of insurance, it stays $500,000 of insurance all the way through. And then, in addition, you're growing what we call cash value. It's a savings portion, if you will, piece of the whole life contract. These cash values are guaranteed. It's a very low rate of interest that's credited to your cash value. And I want to just make a point here of being very clear. I am not for 1 minute purporting to use whole life insurance as a means to invest money, to save for the future as a retirement vehicle. That's not what this is. This is an insurance contract. You are paying, for the most part, most of those dollars you pay in premium are going towards paying premium in your for your insurance coverage. And as I said, the younger you are, the less expensive it is. So if you buy a whole life policy when you're 40 and you're paying $1,000 a year, when you're 65 and you're still paying premium, you're still paying that $1,000 a year. So it's level coverage, and the cash value, maybe in 10, 15, 20 years, you will basically see in your cash value that you will now have in your cash value the same amount of money that you paid in premium. And as the years go on, year 21, year 30, you'll see a little bit of an accumulation there where you have a little bit of growth, which is great, so that at the end of the day, at the end of the time that you either don't want the insurance anymore or, you've maxed out, you've hit age 100, which is when these contracts end, you can either you can cash out the policy, you can surrender the policy and get all that cash value back into your pocket. So if you keep these contracts for a long enough period of time, it's very possible that, 25, 35 years later, which I know sounds like a really long time, but that's what we're talking about when we're talking about insurance products. It is a long-term commitment, not investment, but it is a long-term commitment and an arrangement that you're making with an insurance company. So if you have a policy that you've had in place for 25, 30 years, it is very possible that in year 32, you call up your agent or you call up the insurance company and you don't need the coverage anymore, and you are able to collect back all the premiums you've paid into it over those 30 years, plus a little bit of interest. When we look at those kind of scenarios, sometimes people say to me, Lisa, if I collect back $60,000 in premium, aren't I going to be taxed on that? And the answer to that is that you will collect back all the money that you put in tax-free, and anything that was considered interest or accumulation, you will be paying income taxes based on that. It's the most expensive form of coverage because it offers the most guarantees. They offer guaranteed premiums, guaranteed death benefit, and guaranteed cash values. Having said that to you, the last point I want to make is that this is not a flexible contract, which is what we're going to talk about now, which is universal life. Universal life is a level or adjustable premium and coverage cash value insurance contract. It's also a form of permanent insurance, different than a term policy. You can be building cash value. You can have a guaranteed premium. You can have a guaranteed death benefit, but it is it's adjustable and adjustable for the person who owns the policy. You can adjust the premium up and down based on your ability to pay for it. As you adjust it up and down, obviously the cash value is going to be impacted by that, as well as the death benefit. When we look at an illustration for universal life, you're going to see several columns. The first one is always premium. What does it cost on an annual basis? The second and third columns are usually the cash value columns. The last column is the death benefit. With universal life, you are actually able to see if you're spending $1,000 a year in premium at age 40 and you bought, $250,000 of universal life coverage, a typical universal life policy will show you that your $1,000, $600 of it is going towards paying for insurance, $400 of it is going into your cash value. This is what we call unbundling. So you're unbundling that premium, those dollars, to see exactly how much is the insurance costing. As long as you continue to meet that unbundled premium amount, your life insurance amount, your face amount will remain the same. But again, it's flexible. If you needed to reduce the amount of premium that you're paying because, times got tight, money got tight, you don't need the coverage as much anymore, whatever the reason is, you can reduce the amount that you're paying. And again, if you reduce it below the amount that is unbundled to show the premium, you reduce it below that, obviously your death benefit is going to be reduced as well. It can be guaranteed depending on how you set up the contract and how you maintain paying the money into it. It operates very similar to a whole life policy where you are building cash value at the same time. It also endows or ends at age 100 just like a whole life policy. Very flexible contract. So if you see on the chart I put up now, this is basically a very small review of what I just talked about. You have whole life, term life, and universal life. The cash value in whole life, there is always cash value. It is always guaranteed. Universal life, there's cash value, but it's not guaranteed. It depends on how you put your premium dollars in. Is interest earned on this cash value? Yes, with whole life. No with term, because it's not that there's no interest, it's that there is no cash value with term life. It is purely you're purchasing death benefit only. Universal life, yes, there is interest earned at a minimum rate. Is it flexible? I already discussed that. With whole life, it is very inflexible. You either pay your premium or you don't. And the same thing with term, except that there's no cash value. Are there loans allowed? This is another point I want to make. You're building a contract that has cash value in it. This cash value grows, as I said, tax deferred. As long as you keep the insurance in force, any interest or dividends that are accruing to your cash value grow tax deferred. You're not going to get a 1099 at the end of the year like you would if you had mutual funds or you had money invested in the stock market. You would get a 1099 to show what interest or what capital gains you earned for that year. That's not how it works with life insurance. Any money that grows inside the life insurance contract in the cash value, whether it's a universal life or it's a whole life policy, grows tax deferred. You pay taxes deferred later on down the line. You are able to borrow this money from, and really you're borrowing money from yourself. It's your money, but you're borrowing money out of your cash value. Can you do that with whole life? Yes, as long as there's cash value accumulated. Usually most contracts are written that you're able to borrow between 50 and 90% of the cash value and still continue to pay your premium and still keep your coverage in force. With term life, you can't borrow anything because there's nothing there. With universal life, again, you can make a loan, and it depends on what kind of cash value you have available, depends on how much premium you've paid into it. Premium. Bottom line, how much is affordable? How much are you paying? Whole life, as I said right up front, is the most expensive form of life insurance, but it also offers the most guarantees. Term insurance is the cheapest form of insurance you can buy. Universal life is somewhere in the middle. What I always suggest to people when I'm doing a financial plan with them, when we're looking at life insurance, how much you need, how much death benefit you need, what is it for? Obviously, you cannot buy what you cannot afford. And I don't want people to get into situations where they really like the whole life and they need $1 million of coverage, but they really can't afford it. So what I always suggest to people is, look, it doesn't have to be all or nothing. You can buy several different policies. You can ladder them. You can buy, if you need $1 million of coverage, if it's been determined between you and the person that your advisor that you're working with, that you need $1 million of coverage, there's no reason you can't buy $250,000 a whole life, $250,000 of universal, and $500,000 of term life. There's nobody saying you can't do anything like that. You can be as creative as you need to be. The bottom line is that it has to be affordable. It has to fit into your budget. And it's not something that's going to go away anytime soon. So it's not about making that first premium. It's about thinking about, is this still going to be manageable for me in 5 years, in 10 years? And then you get into a bigger discussion with yourself and with your advisor and whoever else you need to share this kind of discussion with. What are your goals? Where do you see yourself in 5 years and 10 years? Are you thinking about going back to school? Are you finished with school? Are you having children? Are you moving? Is there an elderly person in your family that you're going to have to take care of? All of these things factor into, do you need life insurance? If you need it, how much do you need? What kind of policy? What kind of cash flow are you going to have over the next 5 to 10 years? This all factors into what kind of insurance you need to purchase and what kind of policies would work best for you. The policies are designed to work best for people that understand the need for them and understand the importance of them and are willing to make a long-term commitment to protecting whatever assets it is that they need to protect. The last piece of the life insurance discussion I wanted to bring to the table today is something we call variable life and variable universal life. These are products that, in addition to the dimensions and dynamics that I just described to you about whole life insurance and universal life insurance, now we have variable whole life and variable universal. And what that means is, within the cash value that's accumulating, up until now, with standard vanilla whole life or universal life, those accounts grow and are accredited and accruing interest without any of the investment risk being borne by the insured or the owner of the policy. All of that is managed at the insurance company. If they're guaranteeing 3% interest rate, that's their concern and the insurance company's risk on how they achieve that. They've guaranteed it, and that's the end of it. Nobody's asking the person who's buying the insurance policy, how should I invest the money? How am I going to make sure that we get 3% over the next 20 years? With a variable life and a variable universal, they're giving us an opportunity to offer to the public a policy where you can make investment decisions, where you're asked to bear the investment risk. They operate just like the whole life and the universal life contracts that I just suggested to you. However, there is this piece of it on top of it that makes it a variable contract, which means that nothing is really guaranteed, even in the whole life contract, because everything is based on you putting money into these contracts and directing the investing of how they take the money that's not being used to pay the premium, how they take that money that would be putting into your cash value, how they invest it. And they usually give 5 or 6 or 10, depending on which company you go to, different what we call separate accounts where people can choose. You want a stock portfolio, you want a bond portfolio, you want a combination of the two. There's always a guaranteed interest account, and the investment risk is completely borne on the shoulders of the person who's purchasing the contract or the insured. Death benefit can go up and down depending on whether or not the investment performs the way it's supposed to. And because of that, it's to me, in my professional career of almost 30 years, I will tell quite honestly, to me, if you have a need for life insurance, if you have to protect something, It's black and white. You have to have a certain amount of insurance. A variable contract is not for you. A variable contract can underperform, can completely bottom out if the market takes a huge downturn and you're invested in the market, and your death benefit is contingent upon how those investment accounts perform, and it doesn't perform well, you could end up with much less insurance than you needed or thought you were going to have. So, again, it's out there. It's popular because it allows people to basically do all their financial business under one contract. You can have your life insurance and your investing all in one place. Might be palatable for some people. For some people, I would rather see them open an IRA, participate in their company's 401k, do their investing in a more conventional manner as opposed to doing it under a life insurance contract. What to consider when we're purchasing life insurance? Who will be the owner of the policy? If you're a single person and you don't have children, you don't have a spouse, it's possible that this really isn't an issue for you. However, the only thing I'll say about who's the owner of the policy, when you have a married couple, for example, very often you will have the spouse own the policy. Understand that when life insurance is paid, when a death occurs and the death benefit is paid to the beneficiary, those dollars, as long as it's a person and not a corporation or an estate, those dollars, the $500,000, the $1 million, comes to the beneficiary 100% tax-free. However, the person who owns the policy, which a lot of times it's the insured, that amount of death benefit gets included in their estate for estate tax calculations. Sometimes, if you have life insurance that gets included in an estate, it can bump the estate up to such an amount that all of a sudden we have a tax consequence. So sometimes it makes sense to have the spouses own the insurance. If it's a business arrangement and you have a corporation buying life insurance for a key employee that they're trying to protect the business should something happen to this important person, the corporation might be the owner, and there are all kinds of tax implications which are beyond the scope of this conversation. Suffice to say, it is something to consider depending on your individual situation. How much life insurance do you need? Sometimes it's a very clear cut. I have a $350,000 mortgage and I want to buy $350,000 of life insurance. Sometimes it's not that clear. Sometimes it's about, a need that would arise should a death occur, and you need to look at things like, you're 40 years old. You have another 25, another 30 years of work life left. You need to figure out how much is that? How much is that worth at the end of the 30 years? How many raises am I going to receive? How much more money am I going to earn? Am I trying to save for retirement, and if something happens to me, the person who is going to retire with me isn't going to have the contributions they expected to have? Am I going to need to fund a college for a child, or am I going to go back to school? Am I going to need to take care of my mother or father or grandmother or sister? Am I going to need to pay off a mortgage? All of these factors come into play when you're figuring out how much life insurance. And any good financial planning, insurance broker, salesperson, whatever they call themselves, should be able to provide you with a very simple to a very sophisticated way of calculating what we call the human life value. What is your life worth? It sounds kind of, I don't want to say creepy because it's not creepy, but it can be an eye-opener, shall we say, as to taking a snapshot of your life now and pulling it out another 30 years and seeing really what would your life be worth if you lived till, age 90. And you are able to come up with an estimate of how much insurance. Now, do you need to insure all of that? That's an individual question that needs to be asked and answered. Can you afford to insure yourself for that amount? Again, an individual question. Very often we do these calculations and we come up with these very large numbers that are just not manageable for people. And it doesn't mean you don't buy any insurance. It means you do a proper plan and you buy what you can afford. And you do perhaps what I said. Instead of buying all of it permanent life insurance and locking in that premium for the remainder of your life, you buy a combination. You buy some term insurance. You buy some whole life insurance. Who are you working with when you're buying the insurance? In this day and age, in 2016, in our 21st century, you absolutely can go online and buy life insurance. You can go to a bank and buy life insurance. I feel very strongly that I bring a tremendous amount of value to a meeting that I would have with somebody to help them figure out who they want to work with. You want to be working with someone that you can trust. You want to be working with someone who you obviously have been referred to by somebody else who has used them. You want to make sure the person is properly accredited and licensed. In the United States of America, we have insurance departments in all of our 50 states. Each state department of insurance licenses people to sell product. So if you're living and working in New York, you need to work with an insurance broker who is licensed in the state of New York. There are thousands of us. You need to work with somebody that you can build a relationship with, somebody who's going to listen to you, somebody who is not going to ignore your concerns or invalidate your concerns, somebody who's going to respect you, and somebody who's going to go the distance with you. If you tell an insurance broker that you only have, $100 a month to spend, and they don't listen to that, and they don't respect that, then it's perhaps not the right person for you to be working with. The most important thing is that you feel that you can build a trusting relationship with the person. I'm just running through some review questions here on the screen here. Did you go through a process to determine how much life insurance you need? What type of a product will work best for you? Again, as a good insurance professional, I'm going to ask you questions, and I'm going to listen to the answers, and I'm going to incorporate those answers into my proposal as to how to properly insure you. One thing that I didn't mention here, and I don't have a spreadsheet on, I want to just talk for 1 second about insurability. All life insurance in this day and age in the United States, barring some policies that you can obtain through your employer, if you're buying life insurance on your own, you're going to need to satisfy medical requirements. Typically, it's a blood and urine sample, a battery of medical questions that have to be asked and answered. Everybody is either insurable or not. There is some middle ground where people are insurable, but they might cost a little bit more than somebody else who's their age due to a health history situation. There are people that are absolutely not insurable. All the money in the world isn't going to get them an insurance policy. Again, this is where it's so important that you work with somebody that you can trust and that has experience and brings value to you. A computer illustration, a person in the bank is not necessarily going to be able to walk somebody through this can be quite lengthy process of underwriting with somebody who has a serious medical condition. If you have a serious medical condition, you have type 1 diabetes, you've had cancer in the last 3 years, you've had open heart surgery, you have some kind of hereditary condition, it doesn't mean you're not insurable. It means you have to find the right person who has experience, who has the resources necessary to bring you to the insurance company that will give you the best offer possible. Sometimes the process can be as simple as a couple of weeks. Sometimes it can go on for months. A lot of times when we get into buying life insurance and somebody has submitted medical requirements and they've admitted that they've gone to the doctor in the last year, the insurance company typically will write to the insurance company, they will typically write to the doctor or the provider to get a statement of health. not all doctors take these requests in timely fashion. Sometimes these things can stretch out. Sometimes a doctor will send a statement and it will refer to another doctor in it that they've recommended that the person goes to see, and then they have to write to the other doctor. So it can be a lengthy process. It doesn't, and I don't say that to turn people off or to push people away. I think it's important that people are prepared, and that's another way you can gauge who you're working with. Is the person honest with you about the process? Are they laying it all out in front of you so you know what to expect? Are they asking you the medical questions? Are they probing? Are they listening? Are they taking it seriously? Are they offering information to you? These are all the ways that you could determine whether or not somebody is experienced enough to be working with you, if somebody has enough value for you to earn your trust. My next topic I want to talk about today is annuities. We talk about annuities when we talk about life insurance because they are insurance products. When I talked about life insurance in the very beginning, I suggested that perhaps the idea of a life insurance policy is, for a couple of dollars, for a monthly premium, a quarterly premium, you create this immediate pool of money, a very large pool of money in some circumstances. An annuity is basically the opposite of that. You already have a big amount of money, and the goal of an annuity, the reason people buy annuities, why they're so popular nowadays, is because it's the only product that is available on the market today that will absolutely guarantee that you will not outlive your income. It doesn't guarantee that it's enough money to live on every month or every year, but it guarantees that no matter how long you live, you will be able to collect an income stream. The term annuity itself comes from the Latin term meaning an annual, and generally refers to any circumstance where principal and interest are liquidated through a series of regular payments made over a period of time. An annuity can provide a guaranteed income stream for the life of the annuitant or the owner. No other investment vehicle can offer such a guarantee. Regardless of the actual longevity, the annuity will continue to pay out income for the life of the annuitant. There are two basic types of annuities. There are actually a couple more, but again, for purposes of introducing these concepts today, I want to just focus on two. The first one is a fixed annuity. A fixed annuity is an annuity that's characterized by a guaranteed minimum interest rate and it's guaranteed by the insurance company. There is absolutely no investment risk. And with a fixed annuity, the focus is on the safety of the principal and the stable investment returns. A variable annuity, on the other hand, again, there's that word variable, just if you remember, like we were talking about with the variable life insurance. A variable annuity put up against a fixed annuity is almost the opposite. It offers no guarantees as to the investment returns, and as a result, offers no guarantee as to how the money that is put into these will grow. It is still an annuity, make no mistake about it, and you can structure a variable annuity to guarantee an income stream for the life of the annuitant. You can guarantee a death benefit. However, with a fixed annuity, you're guaranteeing not only that there will be an income stream, but you're also guaranteeing safety of principal and the amount of the money and how much it will grow. With a variable annuity, all you're guaranteeing, if you set it up properly, is that there will be an income stream for the life of the insured or the annuitant, but there is no guarantee as to how large that pool of money or how large that income stream will be. Funds contributed by the contract owner are placed in special variable annuity subaccounts. Within these subaccounts, the annuity owner may choose to invest the funds in a wide variety of investment options. Annuity benefits depend upon the investment results achieved, and the investment risk rests entirely on the contract owner. The goal is to provide benefits that keep pace with inflation. And in a minute, I'm going to give us two examples of very clearly where a fixed annuity is appropriate and where a variable annuity is appropriate. I want to go over some key terms first. The accumulation phase when we're talking about an annuity is exactly what it sounds like. It's the period of time that you are growing your pool of money. The contract owner either contributes funds through a single lump sum or through a series of payments. Each payment is used to purchase accumulation units in the investment subaccounts for a variable, or each payment or each lump sum is put into a fixed annuity and will be accredited with the guaranteed interest rate. The cost of the accumulation units in a variable annuity fluctuates based on the underlying value of the investments. So that's the accumulation phase. That's growing the amount of money that's going to later pool and become this income stream to the annuitant. In a variable annuity, we also have the annuitization phase. Once the contract owner decides to annuitize the contract, in other words, they want to start receiving their income stream, the accumulation units that have been purchased are exchanged for what we call annuity units. The number of annuity units received depends on the price per unit and certain insurance company assumptions regarding income, mortality, and expenses. Once determined, the number of annuity units remains constant. The actual value of these units fluctuate, again, based on the valuation of the underlying assets. The amount of periodic income payable is determined by multiplying the current value of each annuity unit by the number of units that you own. As the value of each annuity unit increases because the underlying value of the assets underneath it increase or decreases, so does the periodic income. Other key terms that are important to remember when talking about annuities. Guaranteed death benefit. Remember I said this is an insurance product. You don't have to go through the insurability and the underwriting that you do when you're buying life insurance. However, there is still a death benefit. Most, if not all, insurance annuity products offer an option to purchase a guaranteed death benefit. Some contracts offer as an optional feature a guaranteed death benefit should the annuitant die before they start collecting payments. This guaranteed death benefit can be, you can buy a death benefit that would basically protect the value of your initial investment. So if you put $500,000 into an annuity and you went along your business for a couple of years and then you passed away, the beneficiary would be able to collect the way the death benefit is usually written. The beneficiary of the death benefit would be able to collect whichever is larger, what the account was worth at the day of death. So if there was some interest that accrued, they would get that. Or if it was a variable annuity and the investments were not doing well and it was less than what was originally put in, the market was down, so to speak, you're guaranteeing that at least what you put in, your initial purchase payment or your periodic payments, that would be the amount that's paid out as the death benefit. Most of these death benefit options that are offered under annuity contracts are not free. So you'll see when you look at an annuity contract, there are mortality and expense fees, M&E for short. And these are the fees that are paid to the insurance company to manage your money, to provide the death benefit, and to cover the expenses of the insurance company. If you don't want a guaranteed death benefit, your M&E expenses will be a little bit lower, maybe a quarter of a point, a half a point, something like that. What's an annuitant? An annuitant is the person whose life expectancy the income stream is based on. Settlement options. The options the owner has with regards to receiving payments. There are things called period certain, life only, and joint and survivor. Let me talk about that for a minute. Again, remember, purchase of an annuity is to guarantee an income. You can take life only, which is what I've been talking about. You have one person who buys an annuity and guarantees that it's going to pay them an income for their life remainder. That's life only. At the end of their life, whether it's 5 years from when they purchased it or it's 60 years from when they purchased it, the insurance company has to continue to pay that amount. Period certain is a little bit different. Period certain says that instead of paying the annuitant for their entire life, that you're going to pay it for 10 years or you're going to pay it for 20 years. Again, these are options that when you purchase the contract, it's a process you go through to ascertain what your needs are. Joint and survivor. So most of the time, the expectancy, the life expectancy, or the mortality of the person, of the annuitant, is what's taken into place to calculate how long this pot of money is going to last. And again, it's the insurance company's responsibility to make sure that regardless of what their expectancy is, if they think the person's going to live till they're 87 or till they're 92 and the person lives till they're 103, it doesn't matter. If they have committed to paying a life income, then they're going to have to pay for the rest of their life. You can, with a legal spouse, insure both people. So you have a situation where you have the primary annuitant who purchases the annuity, and at the time of purchase, they decide that I want you to pay me for my life. If I pass away, I want you to pay my spouse for the rest of his or her life. And then they're going to look at the mortality for both people. The payment, the actual monthly income stream, is going to be smaller than if it had been on just one person, but because you're covering two lives. Let's talk about taxes for a minute. Tax treatments from an annuity will vary based on where in the life cycle of the annuity the payments are made. If funds are taken out of the annuity before the contract has been annuitized, in other words, you have not notified the insurance company that you want to start getting your income stream, but you decide that for whatever reason you need to take money out. The money that comes out is taxed as ordinary income. In addition, if funds are withdrawn, because remember, an annuity is a retirement product, and as such, all the growth that occurs within the annuity contract, all the interest, all the accumulation, is, again, it's a tax-deferred vehicle. This is why we have annuities. This is how our government encourages us to save, right? Whether it's an IRA or it's through the 401k or whatever it is that you have at work, or you're buying an annuity. A lot of those principles operate in the same way. To encourage people to save for retirement, the government allows people to put money into vehicles that are qualified plans like an annuity, and that the money that grows tax deferred. You don't pay income tax every year on what you earned inside an annuity. It's deferred until you either start taking your payments or until you surrender the contract. When you surrender the contract, it depends on, that's how we determine whether or not all of it is taxable or some of it. So if you take money out of an annuity before you're 59 and a half, just like if you pulled money out of an IRA, there's not only is there an income tax penalty, but there's also a 10% penalty if earnings are completely withdrawn and payments are then made from an owner's initial investment. Withdrawal is treated as a tax-free recovery of capital. So if you buy an annuity with after-tax dollars and you decide 5 years in you need some of the money and you're not 59 and a half yet, you're going to pay tax on the interest that they calculate. You're also going to pay the 10% penalty. If you take money out after annuitization, after you are receiving your income stream, how do they calculate? Is that considered totally taxable? And so after annuitization, regular annuity payments are treated as part earnings and part return of capital. Earnings portions taxed as ordinary income. Once the owner has completely recovered her investment in the contract, all remaining payments are fully taxable as ordinary income. Also still subject to the 10% federal income tax penalty if the person is annuitizing prior to age 59 and a half. My next slide will give you a quick comparison of annuities. Fixed annuities, variable annuities. Remember I said, under a fixed annuity, guaranteed fixed rate of return, low to no investment risk. So as a result, when you're in the world of investing, the more guarantee that you're asking for, the more safety of principle that you're asking for, the less likely that you're going to have the ability to earn a lot of interest. It's a direct correlation. If you are completely risk averse in terms of you cannot take the chance of losing any of the money, any of the dollars that you're putting into the annuity, then you're putting it into a fixed annuity, you're going to earn a very low rate of return, 2%, 2.5%. With a variable annuity where you are willing to bear that investment risk, you can put your money in and you can choose where your money is invested, and you could earn whatever the stock market or the investments are earning. You could go as high as 10, 11, 12%, or conversely, the market could drop. We could have a catastrophic something, and you could lose not only any interest, but you could also evade principal and lose some of your principal. There is no guaranteed rate of return with a variable annuity. With a fixed annuity, you have no options for investment selection. With a variable annuity, you have several types to choose from. And remember, again, what I always say to people when they look to make any kind of investment, whether it's in the bank or it's a mutual fund or it's stock or it's an annuity, that the goal of the annuity or the investment product should meet your goal. If your goal ultimately is safety of principal, you have no business being in anything that's going to fluctuate. You need a fixed product. You need a fixed annuity. If your goal is to provide benefits that keep pace with inflation, then you need to be in something that's going to give you exposure to the market so that you have the potential to earn the returns that you're going to need to keep pace with inflation. My last two areas here, I want to just show you two scenarios where a fixed annuity is appropriate and a second scenario where a variable would be more appropriate. So let's look at this for a minute. We have Annie. Annie's retiring from her position at the printing company that she's worked at for 32 years. Her employer will be transferring the money in her retirement plan to her, as the plan does not allow for money to be held for employees no longer employed at the company. So understand here, she hasn't retired. She just she's leaving her position there. She's quitting. The plan was designed where all the contributions were from the employer, and the employee had no control as to how it was invested, which is a very traditional form of pension plan. It's not something we see a lot of anymore. Nowadays, when you work for a company, most of the time you're going to see a retirement plan in place that has a place for the employer to make a contribution and a place for the employee to contribute as well. It also allows for the employee to make the decision about where the money is invested. I'm not talking about that. In this particular example, I'm talking about a situation where it's a traditional pension, where based on years of working at the company, based on income, however the plan was set up, the employer puts a certain amount of money away on behalf of each of their employees. And at the end, when they retire, when they're 65, when they're 70, whatever the retirement age is, they're guaranteed to receive a certain amount of monthly income. That guarantee is based on the investment risk that is borne by the employer solely. The employee has nothing to do with where this money is being held. Annie wants to know that her money will continue to work for her by growing and by providing her with income when she retires in about 10 years. Her plans include starting her own business and continuing to contribute to a retirement plan for herself. She purchases a fixed annuity with the entire balance coming from her employer's retirement plan and will collect a guaranteed monthly income starting in 10 years. She will not be involved in choosing where the money is invested, as this is a fixed annuity with a guaranteed stated interest rate. When the time comes, her income stream will start and will continue until her death if no other options are selected. In addition, she has the ability to select the beneficiary to collect the death benefit upon her demise. So that's a perfect example, especially in our world today where so many people, not so much in 2016, but I have run into, I can't even say how many of my clients, how many of my colleagues, how many people I know in my life that lost their jobs over the last 10 years, that were downsized, companies left the area, whatever it is, and they were people working in larger institutions, banks, hospitals, universities, and they were let go. And they had these retirement accounts that had substantial assets in them, $750,000, $1 million, whatever it is. And they were always working under this assumption that when they retired, their employer was going to provide them with a monthly income. And they had no idea how they were going to do it or what they were invested in, but because that was something that was borne by the employer. Suffice to say that it was something that the individual employee did not need to think about. They just knew that they were guaranteed to get, once a year they'd get a statement, and they would say, if you retire today, you're entitled to, X amount of dollars per month. when people were downsized, they were faced with this reality of, oh my God, I have all this money. How am I going to make sure that it stays this amount and that I'm going to continue to be protected, that I'm going to get an income stream that was equal to what I would have gotten with my employer? A fixed annuity is a perfect product for that. My next scenario is Rose. Rose was downsized from the bank after 19 years as a customer services manager. She had participated in the bank's 401k for all those years and had accumulated almost $350,000. She was accustomed to choosing her own investment option. So Rose took that $350,000 and purchased a variable annuity that will allow her to continue making her own investment choices while continuing to earn a return that grows tax deferred. In addition, Rose was concerned about what happens to her $350,000 should she suddenly pass away. Could she make sure that her family collects it? A variable annuity can guarantee a death benefit equal to the initial investment in addition to providing an income stream at retirement. In addition, she'd be able to continue to make her own investment choices by using the various options available to her under her variable annuity contract. So there you have it, everyone. Life insurance and annuities. Hopefully, I brought you a practical introduction to the products. And remember that, we invite you to ask questions. Please feel free to either email them or put them in the chat box, and I will answer them if I can in a moment. I also want to let you all know today that I would offer a free consultation to anybody who calls me. As you can see, there is my phone number, there is my email address, and the address of my website. I thank you all for participating today. I look forward to any questions you might have. Thank you.
Thanks, Lisa. So as Lisa mentioned, if you have a question now, you can type it into the chat box or you can email info@savvyladies.org. One of the questions we had come in is, should I be asking an advisor how he or she came up with the number for how much life insurance I need? Is everything in my life really getting considered when that number is calculated?
That's a great question. And as I had said during the presentation, absolutely you should be able to ascertain how this advisor came up with that number. Hopefully they came up with it the way I would come up with it. They asked you a bunch of questions. Do you have a mortgage? Do you have dependents? Do you have anybody in your family who's dependent on you financially? Do you have loans? Do you have anything that needs to be protected? Do you have a charity that you want to make a donation to? All of those questions are factored into how much life insurance somebody needs. It's a very individual process. There is no such thing as saying, you're 35 or you're 50. So if you're 50, you need $1 million of life insurance, and if you're 35, you need $750,000. It's a very individual process, and it is absolutely a process that you should be part of with your advisor.
Okay, great. Thank you. And another question we have here is there a minimum investment amount that needs to be met to purchase annuities?
Sometimes. It depends on the product. There are all different kinds of products out there. If it's a variable annuity, usually it's based on either an annual first-time contribution, or if you're committing to doing it on a monthly basis that you're actively saving, there are minimums. Most of them start with $2,500 or $5,000, with being able to make a commitment where you're basically allowing them to auto draft money out of your bank account once a month. If you sign up like that, sometimes you can depending on the insurance company, depending on the product, you can get them down to $50 a month, $100 a month. If you are looking for an immediate annuity, in other words, you're looking for a product that is going to start paying you an income stream right away, that's called an immediate annuity. And very often those are larger commitments. They want $100,000, they want $250,000. It depends. So again, these are the questions that an advisor should be able to answer for you. But yes, as a rule, there is a minimum. You cannot open an annuity with $10.
Okay, thank you. And the next question is, I've heard some different things about ILITs, irrevocable life insurance trusts. I know it
Hmm.
wasn't really talked about in this presentation, but are you able to talk a little bit about the pros and cons in those?
Sure. An irrevocable life insurance trust is a tool, a financial tool that's developed to protect assets when you have a situation where there is going to be estate tax consequences, or where I've seen it used also is when you have uh, perhaps a person who is directly involved in the finances of the family or the business who cannot manage their own finances for whatever reason it is. So we set up a trust, which is a separate entity. It gets its own tax ID number, it files its own tax return, and the word irrevocable means once it's set up, you cannot take it back. So we set up a life insurance trust, and we make the owner of the insurance policy the trust. The trust. So now the life insurance policy sits inside this trust. The insurance, the premium for the insurance is paid for with dollars that come out of the trust. So when you set up an irrevocable life insurance trust, you're also usually putting in money, again, to get it out of somebody's estate, because once it's put in the trust, it no longer belongs to whoever gave it to them. So if that person should pass away and they have a lot of money, you're taking things out of people's estates to minimize how big the estate would be upon death and minimizing the tax bite. So those are the pros, and that's why we use them occasionally. So you have an attorney draft up a trust document. You file with the state for a tax ID number. Every year, the trust needs to file a tax return. So I guess the cons would be it's not cheap to do this. It would cost several $1,000s to set the trust up, and then it has to be managed. A checking account has to be established for the trust, and as I said, a tax return has to be filed. So those things cost money. To hire an attorney or a CPA to take care of the necessary required documentation annually probably cost another $1,000 a year just to do that. However, if you're talking about a family or a situation that's worth millions of dollars, or you're talking about protecting a disabled person, and you need to keep things in trust for them, a couple of $1,000s to set it up and $1,000 a year to run it is nothing compared to what's at stake. So I would say, again, it's a sophisticated planning tool that is utilized by people that have reason to use them.
Okay, great. Well, those are all the questions we had for now, Lisa. So I want to thank you for a really great presentation. And I believe you said if people have further questions, they can contact you.
Absolutely. We'd love to talk to them.
Okay, great. Well, I want to thank everyone for joining us today. And thanks again, Lisa.
Take care, everyone. Thank you. Bye-bye.